On the FX side, it's interesting to me that the majority of people I speak to are so confident about the recovery globally, the recovery, the stabilization in China, the bleed through to the rest of the world. And yet, Bob, still, we have a stronger dollar story on our hands. We can't break out of this range seemingly. And when we do, it's with dollar strength, not with dollar weakness. Why?
Because it's the high-yield government bond market. Who would have ever thought? Who would have ever thought that to sell Australia and buy the U.S. is a PIK yield trade?
This underpins your bullishness in Treasuries at the moment. And that's a change for you, Bob. I have to admit, over the last couple of years, you were looking for yields to break out. What underpins that change from abroad? What specifically is it about the United States that is so attractive right now?
Well, there are a number of things. One is the high yield. And I know when you look at the flow, say, coming out of Japan into the U.S., you don't get the same currency exchange rate benefit that you did in the past because it's roughly the same when you compare government bonds. But what you do get in the U.S. is the ability for capital appreciation, the ability for yields to go lower, the ability for the 10-year Treasury to go from, say, 2.5% to 2.25%. You're probably not going to see that in JGBs with the 10-year at -5 basis points.
So you've gone from someone who potentially could see yields up to 3.5%, maybe even 4% on a 10-year, to someone that would be buying the U.S. Treasury if yields started to creep back up?
The world changed in the fourth quarter. The first thing that happened is the midterm elections, so you're not going to get any more fiscal stimulus. No tax reform version 2, no fiscal spend. The second thing that changed, the Fed on a mission to get to 3% and run down the balance sheet just abruptly stopped. Without those things happening, I could sit there and try and fight it, or I can accept that's the new reality and be part of it.
So you expect to see lower yields here in the United States and also a stronger dollar? Both of those things at the same time?
The Fed is telling us that they're done. I believe them. I think there's so much money looking to come in to the bond market that the 10-year potentially could sink to 2.25% and sit there like a block of cement.
Over what time horizon, Bob?
By year end.